Closing costs on a home purchase or refinance fall into one of several categories. There's bank fees, taxes and government fees, third-party fees, and prepaids. On average, it's like 1 to 2% of a purchase price, typically. So how does that work? What does it cost? And how do we keep those costs low? Well, buying a home requires the help of a lot of different people. Realtors, there's lenders, there's a title company, there's an appraiser, there's insurance agents, there's home inspector, there's county assessors. And so there's a whole lot of people who have their own fees that we need to figure out how do we calculate these costs that are called closing costs. So we'll break them down. Number one, bank fees. Different banks will have different fees for their work. Some banks will charge origination, or there's underwriting fees, processing fees, but keep in mind the bank can only control their fees. They're just one piece in this bigger puzzle. Now, if one bank is charging origination and another is not, that could be thousands of dollars that bank is saving you. 1 point origination on a $500,000 purchase is going to cost you $5,000. So that's kind of the bank fees. Number two, taxes and government fees. When you buy a home, you have to go through a process of becoming the legal owner of that property. That's called taking title. And that's what closing on a home is all about. There's government records that show someone else as the legal owner, and so we actually have to transfer that title into your name. The document that legally transfers ownership is called the deed. Once you've closed on your home, your title company or escrow company will ensure that the deed is recorded with the county assessor's office. So there's recording fees that go along with that. There might be some state taxes you have to pay too. That's the taxes, government fees, transfer taxes, things like that. Number three, third parties. We've got appraisers to pay and a title company. The title company has the job of finding all the records that go with that property and making it absolutely sure that it is the seller's property to sell. A couple things can go wrong here. Sellers might have like a long lost heir or a former spouse showing up saying, wait, that house was actually willed to me after the sale has gone through. Or the sellers may have had like property taxes they never paid or a contractor they never paid who did work. And if the sale goes through, the new owner becomes legally responsible for those debts as they're tied to the property, not the owner. So the title company does the job of running a title search. That's going to usually catch most of these things what would pop up, and they'll prevent the sale from moving forward till the title is clear. But if a problem does come to light after you've purchased the home, title insurance will protect you from any of the financial loss you would incur. Whereas most insurance policies protect you from what could happen in the future, title insurance protects you from what could have happened in the past. So as you can see, there's a lot of individuals and businesses working together to make sure everything goes according to the plan. All of those are indispensable, and each of them have their own fees. The last category of closing costs are prepaid. Things like your HOA, property taxes, homeowners insurance premiums. You'll have to pay some of that at closing. If you're escrowing, you'll have to pay several months of taxes and insurance into the escrow account at closing as well to load that up. Those are the four main categories of expense for closing costs and a basic overview of what you're paying for and what you're getting for that money. Now, let's talk about adjustments and how we can keep our closing costs low. Adjustments are things that you've already paid or other people are paying for you. So things like earnest money. That goes against your down payment. If you pay $5,000 in earnest money and you're bringing $100,000 down, you only need to bring $95,000 more to closing since you've already paid the first $5,000. Earnest money is an adjustment. Or a loan deposit. If your bank requires a deposit for the loan, that's going against your closing costs as well. You'll basically see it as an adjustment. There's a few adjustments that you can negotiate into the contract to keep your cash to close low as well, like seller credits. Seller credits are where the seller are giving you money to go towards closing costs. A motivated seller might be willing to kick in 2 to 4% of a purchase price to cover closing costs. So on a $500,000 purchase, 4% is $20,000 to go towards your closing costs. But remember, the more you ask for, the less compelling your offer will be. Seller credits can be huge to keep cash to close low. Also, lender credits. Another way to lower your cash to close is by taking actually a higher interest rate to get credit towards your closing costs. So say your rate was 4% on a $500,000 loan. You could say, what kind of credit could I get if I took a 4.5% interest rate? That might save you $5,000 in closing costs by generating a lender credit. It's like the exact opposite of buying points, where you're coming out of pocket at closing to get a lower rate. With lender credits, you're paying a premium rate to get lower upfront cost. One more adjustment you might see on your loan estimate is tax proration. This happens because property taxes are paid semi-annually or annually in most counties. You might move in and then get a tax bill for a time you didn't even live in the house. So tax proration is giving you credit for that time. What else can we do to keep closing costs low? Number one, shop lenders. Like I said, if one lender is charging origination and the other is not, that's a lot of money you could be saving. Number two, shop homeowners insurance. One company to the next could save you $100 a month in homeowners insurance. Number three, look into down payment assistance or grants. Different states have different programs to help, especially first-time home buyers, get over that down payment hurdle in different ways. Except for your deposit and the earnest money, you'll pay all of the rest of these at closing. We'll do our best to estimate what those costs are going to be up front, right at the start of the process. But since we don't know what all of those other companies are going to charge, all we can do is estimate. We'll know for sure once we get closer to closing. And 3 days before you close, we'll give you an actual initial closing disclosure that'll have it all pretty dialed in. Cash to close will be pretty solid. You'll be able to see what we estimated for each fee and whether the actual cost went up or down. I'm always going to try to estimate a little high so that you're pleasantly surprised, even though other lenders often estimate way low to get the deal and then disappoint you when they say, oh, our rates were actually way worse than I thought. I'm never going to do that. I'm going to try to give you full transparency all the way through this process. I'm never going to charge junk fees. I'm never going to obfuscate things. I'm always going to do everything I can to waive origination. There are a few loans that we can't do that on, some government things, but most closing costs are just kind of common to all loans. There are a few differences with certain loans like FHA, VA, USDA. These have mortgage insurance that pays up front. Upfront mortgage insurance is big. FHA charges 1.75% of the loan amount. That's added to the loan. You'll always pay it. It's rough. VA has a funding fee. USDA has a guarantee fee. AIO has approximately $2,000 in additional charges to set up the HELOC and the sweep checking account. So while most closing costs are common to every loan, there are a few distinguishing discrepancies. The last way we can work together to lower your closing costs is to wrap the closing costs into the purchase price. Now, we can't roll the closing costs into a new loan on a purchase, but we can wrap them in. So this is how it works. Say it's a $500,000 home and you anticipate about $10,000 in closing costs. You can offer $510,000 with the seller paying $10,000 in closing costs. Keep your costs really low. Refinances are different, obviously. They do allow you to roll the closing costs into the new loan. Most AIO refis that we do are $0 cash to close because we just roll the closing costs into the balance of the new loan. So that's a brief overview of what you're paying for, when you're paying closing costs, what to expect, and how it all works. At North Point, we never charged any of that junk, like I mentioned, that other lenders will. We're always going to try to be transparent up front, and we'll always make ourselves available to answer any questions that you have about what is what. Okay, there's no origination on most loans. Full transparency on all loans, and no junk fees. That means you're in really good hands here. Because we're not just interested in getting your next loan. We want to take such good care of you that you actually never have to think about who's a trustworthy lender again. We have so many loan options that we want to help advise you on which loan, at which rate, and when to lock, what makes the most sense for your goals, your needs, and your season of life. Over time, hopefully you'll see that we really like working with you. We really like you, and we're really for you. As much as it's possible, we're going to work to make sure that you enjoy working with us too. And as always, you can reach out with any questions. We can't wait to speak with you.